François Rochon, the president and portfolio manager of Giverny Capital, is with us. Welcome.
Thank you.
It's a pleasure to have you on the program. Love to learn about how you identify great businesses and what are the best ways to invest in them. Before we do that, it would be nice if you could tell us a bit about your background and what got you interested in value investing.
Well, I think I got interested in stocks many years ago. I was very young. I remember I had this board game called Stock Ticker, and I would play days and days and days until I had all the money in the board game. And I started to follow the stock market pretty young, but I didn't really understand what all these little numbers meant. To me, it was a randomized game, and so I never considered it to make it a career as a youngster, because to me, it was a big casino worldwide with lots of sharks all around. So that was the image I had of the stock market. So I decided to do something serious with my life. So I became an engineer, and the world of science really attracted me, and still does. And after my engineering degree, I went to Paris, and I went to Giverny, where Claude Monet had his famous garden, and I really loved art at that moment. Claude Monet was my favorite painter at that time. So I went to Giverny, and I really loved the space, and I wanted to have this dream, this vision of building something similar in Quebec, in Montreal, and where I lived, with Quebec-based artists of my era, and build this marvelous, a similar marvelous garden. So I knew I had to be rich to do that. So I decided that engineering was not the way to get rich, and the stock market, which already attracted me, was probably a good way to go. But I didn't know nothing. I didn't know anybody that invested in the stock market. So I did most of the research on my own, and I tried lots of different things. I read lots of books, and about 20 years ago, I read about Warren Buffett. First, I read it in Peter Lynch, One Up on Wall Street, which I read in '92, and he talked about Warren Buffett in that book. So I wrote him, and at that time the internet didn't exist. So he sent me a big package with all the old annual reports, and reading that with other readings on of Philip Fisher and Ben Graham really opened my eyes. It really transformed my vision of the stock market. It was no longer a casino or a randomized activity, but you could use your judgment, intelligence, and rationality to find great companies and to buy them when their prices are good. So I had already started to work as an engineer, and I started to invest in the stock market. Did pretty well. So after a while, I decided to leave the engineering and went to work as a portfolio manager. And after a while, I started Giverny Capital. I started Giverny about 14 years ago now. So that's my little story. And every year I write this letter, which is very inspired from Warren Buffett's letter to his shareholders.
Now, it sounds so simple to buy great businesses at good prices, and I'm wondering, how do you go about it? How do you identify great businesses?
Well, I think finding great businesses in the stock market is not that hard. The hard part is to have an independence of thought, buying something that no one else does because it's not liked or because nobody knows about it. And I always say that I think you need something peculiar to do well in the stock market, to do better than the others. And I have this little theory about it, and I say that I think as human we are programmed with a tribal gene, where we tend to follow the tribe. I mean, we're programmed like that. And I think that some of us, I don't know the exact percentage, probably something like 5%, we don't have that gene. So we can easily go that way when the tribe goes the other way. And I think you need to have this missing gene to be able to do better than the others in the stock market. It's not about finding great businesses. It's about being able to have independent thoughts. I think that's the great thing. Once you have that gene, and if you do, you do. If you don't, well, that's life. I call it, you have to have the missing gene. It sounds a little paradoxical, but that's really is my theory. And then, obviously, you want to own great businesses. You want to own them usually before they'll do very well or continue to do very well. How do I find them? I would say I look everywhere. I mean, my capitalist antennas are always on. Everywhere I go, every ads I see on TV, well, you know, I see this ad for a new restaurant chain that looks very interesting. Well, I'll try it, and if I like it, my next step will see, well, let's see if this company is public. And I look at all sorts of industries. I try to avoid things that are too complicated. I think that's one of the key to know what to avoid. And I avoid complicated businesses. I avoid companies that change too fast. I avoid everything that is linked to a commodity or the product they sell. I don't see any competitive advantage. Besides that, I try to look at every source of businesses. And basically I look at everything, and I'm a big baseball fan. It's like watching 3 baseball games a day for 20 years. Well, after a while, you've seen almost all the players, and you can see who's you like to have on your team.
Now, you're based in Canada.
Yeah.
And do you invest globally? Does that search very much encompass all of the companies in the world as much as you can find them?
Well, I look everywhere, that's for sure. North America is closer to home, so it's easier to hear about companies, to visit companies, and to try restaurants or hotel chains or retail stores, and it's so easier. But you know, we've owned some Japanese company, we still own an Australian company, and lately we've been looking in UK. So we try to look everywhere, but obviously distance is a factor because we want to know the company very well. We want to know the management, so we'll tend to stay in North America. But you know, in the recent years, we've looked everywhere.
So can you, even though it may be easy for you to identify a great business, can you share with our audience just some ways of what are perhaps your more favorite business models, and which ones do you tend to avoid?
Well, since I'm an engineer, I have these filters in my head. I try to remove things pretty quickly. So, while my first criteria, it's got to be a profitable business. So we first look at, you know, the numbers. Is this company profitable? Does it have good return on equity? Does it have good margins compared to similar players in the industry? So, but that's the easy part. You just look at the numbers, and you can use Value Line, for instance. And after a while, you've removed perhaps 95% of companies just based on simple numbers. So, and I like this phrase by Warren Buffett. It says, if a company has a great future but a lousy past, I'll miss it. So we look for companies that have a great past, a great present, and the harder step is to see if the future looks as promising, because nobody knows the future. It's easy. Warren Buffett says that if it was only past data, all librarians would be rich. So but that's where we start. We try to find companies that, in our standards, are good businesses. They earn high return on capital. Well, the next question is, why has this company been doing so well? What is the product of the company selling? And we try to find something, a competitive advantage, franchise value, a moat, whatever we want to use as an expression. We try to find something very unique that this company has that his competitors doesn't have. A niche or some ways of doing things that is a little better than their competition.
And what is then better in terms of that specific or special thing that a company possesses? Do you prefer companies that have a competitive advantage through large scale or more through something else? Can you give us a sense of, based on your experience, what do you really get excited when it comes to a business?
Well, there's so many different competitive advantage. There's so many different business models that work. And sometimes you find them in industries you wouldn't think. An example that comes to mind is Nucor. We owned it for a while, 15 years ago. So, but the steel industry has been a very tough one, but Nucor has managed to do very well. Probably is because they treat the employees very well and they have a very low cost structure. But it's a tough business. So, but one company that we've been owning for 6 years now is Bank of the Ozarks, which is a small bank in Little Rock, Arkansas. And they're very low cost, but I think the key to their success is their CEO. It's George Gleason. And, when we invest in a bank, what we're really doing is investing in a banker, because you never know really what are the assets and liabilities and what kind of loans, and usually the liabilities are pretty solid, but the assets it can be a little less solid. So you want a CEO that is very conservative. And when I met Mr. Gleason, what really struck me is how well he knew, it seems, all the loans that the bank was doing. So I think doing very simple things, but doing very well and very conservatively, and not trying to be on the latest fad and not trying to find shortcuts. I mean, Mr. Gleason has been managing this bank for 33 years now. So he's been building something for very long, and he has a very long-term horizon. And the financial crisis, he did very well. The bank had some non-performing assets, but a low ratio compared to other FDIC banks, and they were able to make great acquisition at very, very low prices. So probably they've increased their assets by 50% in the last 2 or 3 years. And so I think the companies, this year they'll probably earn more than twice what they were earning when we purchased it in 2006. So, but in the case of Bank of the Ozarks, it's just simple banking, low cost. They have an efficiency ratio in the 40s, so it's really, really something. And they just manage things very thoroughly.
When we think of great businesses, banks usually don't come to mind. So is this very much an exception, and based on the quality of the management then?
Well, I think the key criteria is management. I mean, a few years before Philip Fisher passed away, I had a chance to talk to him. And he said that he had emphasized management all his life, but he hasn't not emphasized it enough. That's the key criteria. And I always say, when you buy a stock, what you're really doing is becoming partners with the management. So if you want to be a good stock picker, you have to be a good manager picker. And I think that's one thing that we look at P's, ratios and all that, but beyond that, I think you have to emphasize the quality of management. And one of the stock we've done very, very well, it's a Fastenal. We owned that for 14 years. We bought it during the Asian crisis, so it's been a while. October '98. So I think we've done at least 15 times our money. So we've done very well. But the key reason we bought it was because Robert Curling at that time was managing the company. And I mean, we were lucky to get it at a lower P than usual, but that's not because of the low P that we did so well. It's because Mr. Curling and his successor, Mr. Oberton, have done a great job.
Some would say that picking managers is even more difficult than picking stocks. Can you give us some insights into what do you then look for when you meet a manager, or even before you meet a manager? How do you go about getting that comfort?
It's not easy. You're right that it's much harder than picking low PE stocks. I'll give you this analogy. I collect art. I want to build this museum in 30 years or so, so I like to buy contemporary art that I hope in 20, 25 years will be considered important. And that's not easy to look for good art, because by definition, creativity, new art is something that did not exist before. That's the act of creation. You build something where there was nothing before. So you're in new territories, and you want to look for managers that are in some way artists. They are creating a company, they are creating their market, they are creating a culture. So you want to look for same qualities that you look in art. And if you find managers that, just from the sound of their way they talk, they follow the crowd, they speak the wise word that you hear all the time, well, that's very nice. They've got a good education and everything, but they're not creative. What I want is someone that I feel has independence of thoughts, sees new way of doing business, want to build something for the very long run, and want to build it according to his vision of things. And the only way to identify it is to have judgment. And ideally, you've seen enough of good managers to recognize what makes a good manager. And it's like art. If you look at lots of art every day, you go to museums and galleries and you look at all those contemporary shows, after a while you'll find artists that really are kind of, defining new standards in creativity, and those that are just, doing the same as before, just with a different touch. And I try to find the great creators. And perhaps one example I could use is 7 years ago we invested in Disney. The day that Bob Iger was named CEO in September 2005. And I knew a little bit about Bob Iger. He was a protege of Tom Murphy. And that's a very good thing on your resume. And but I read a little bit about him, and I said, well, I think this person will do a big difference in the Walt Disney Company. And it has so far. Big difference. I mean, we bought the stock at 24. I think it's close to 50 now. I think Bob Iger he wouldn't say it if he was here, but I think most of that $26 rise per share should be attributed to his great management skills.
With people who are our audience, some of the people who may not be as familiar with Walt Disney and the developments there, what can you share with us some of the specific things that Bob Iger has done that had made a difference?
Well, I think he changed the culture first. I think before him it was becoming a hard place to work, and I think he really emphasized a return to the quality of creativity, of people taking risk and doing new things. I think his main achievement was to be able to acquire Pixar. I think that was a key thing. And acquiring Pixar needed the Walt Disney Company to be able to sit down with, Steve Jobs at that time that was managing Pixar, and the relationship had become a little sour, and I think the contract was due for renewal, and it was not promising. And I think Bob Iger did a very, very good job of acquiring Pixar. And after that, he acquired Marvel, which owned many of the superheroes franchise, and I think they really have helped the company to go beyond their original business. But the key thing, I think, in Disney is they own their stars. I always say that the greatest quality of Mickey Mouse is he doesn't have an agent. The company owns it. He's immortal. He's known all over the world, so you can do all those things. You can sell all those retail store related consumer products based on Mickey Mouse, or the Cars movie, or Toy Story movie, or Spider-Man movie. So that's a great thing when you own your stars, and these stars are immortal. And I think with Bob Iger, this great franchise of Disney have been, really improved the way they emphasize it profitably on that. We also should be thankful of the ESPN management team, because that's been an incredible value for Disney. I think most of the profit, the biggest contributor to the profits is ESPN. So, and they acquired that when they bought the Capital Cities ABC. I think it was in '96, and that's been a great franchise for them.
What are perhaps some of the managers that you admire outside of the U.S.? Everybody knows the best managers in the U.S. They get quite a bit of attention. Have you found similar quality managers abroad?
Oh yes, I mean it's not the U.S. thing to find great businessmen. Close to home, there's two companies in Montreal that I think are extraordinarily well managed. One is Dollarama, which is a retail chain of dollar stores, and it's managed by Larry Rossi, and I think very highly of him. And for many, many years I wanted to own shares in that company, but it was in private hands. But about 2 or 3 years ago, the company went public, and we bought it almost at the IPO. So it's so rare that we buy IPOs, but I think that's the only one that really comes to my mind is Dollarama. It's done very well, and I think it's because Larry Rossi is such a great manager. And the second one is probably one of my favorite company in the world right now is MTY Food, which nobody knows about. And it's also based in Montreal. It's managed by Stanley Ma. And Mr. Ma is very low profile, but I think he's an incredible businessman. He really knows about his circle of competence. I mean, what they do, MTY, is they own franchises of, they own 25 restaurant chains, and they sell to franchisees, but these are all small concept of restaurants, usually based in malls. So there's one of Greek food, Chinese food, Italian food, ice cream, Thailand food, chains of tacos, name it. They've got all these little stores, and they're very small, and I mean, some of them have been around for many, many years, and they own this Chinese outlet called Tiki Ming. And I had one friend that asked me about R&D at MTY Food, and I said, well, what R&D do you need to make egg rolls? I mean, it's the same egg roll today that they sold 30 years ago. I mean, That's what I like about that business. So it throws a lot of cash. It doesn't really need R&D or capital improvement. They're in small restaurants, so it's always the same plant and equipment. So it's a very good business. And they, with the new money that comes every year, they just buy some other chain. And they've been doing that for many, many years. And I mean, sales earnings have grown 25-30% a year. It's been phenomenal. It's still a small company. It's about 400 million market cap, so it's pretty small. But I mean, I think they can grow for many years in the future. And I think the key thing is Stanley Bond. And I'm really, really happy to be a partner with him.
What about how far can you push that argument about a manager? Warren Buffett, whom you've quoted a few times, even said something to the extent that if you have a good manager or a good business, you always would prefer a good business at the end, because ultimately somebody else will run it who's not as good. So how do you deal with that?
Well, my first criteria, as my first filters, is a good business. I mean, they have to have good margin, they have to be profitable, good return on capital. Usually it's the definition of a good business. But I want to know why it's been a good business. I want to be sure that it's going to stay a good business. And I mean, having a great manager at the helm of the business, it's not, you never know the future, but I think it improves the odds that the company will continue to do well. Because, this investment thing of finding great businesses and holding many years, it's a tough thing because odds are against you. I mean, the forces of the law of the normal is that every business will tend to the mean. So most superior companies, more superior businesses won't stay superior many years in the future. So you're trying to beat the odds here. You're trying to find companies that you think are really, really unique, have this great person managing it, so that even if the odds are a little against you, you'll do well. But I think you want to own great businesses at first, and secondly, ideally, you want a great CEO at the hand.
Now, of course, most people would agree that which the great businesses of the world are, who the great managers are, and so can you give us a sense for what do you look for to get involved? What are perhaps some of the reasons why a great business or great manager may be temporarily, hopefully, overlooked by the market, and when do you invest?
Well, the thing with great businesses, when people realize it's a great business, is sometimes, not all the time, but sometimes it has become a little mature. It's so big that it's hard to grow at 12-15% a year. Well, a company like Coca-Cola, I mean, they can't grow sales by 12% a year. They can grow 6, 7, 8%, and that could be enough if you purchase it at a good price. But so that's the one thing. Usually, when it's very well known, it's very well big and it's mature, and like Intel, when they own 85% of market share in the PC processor industry, and the industry is not growing very fast anymore. Well, there's not much they can do about it. Same thing you could say about Microsoft. So, and but sometimes it's really strange that you can find a great business with good prospects, and for a temporary reason, the stock is undervalued. And one example of that is Visa, that we bought, I think, in 2010, at the end of 2010, when there were some worries about debit card fees, and the stock went from, I don't remember exactly, from 95 to 70 or something like that. So we thought we were buying one of the greatest business in the world. And I mean, who doesn't know about Visa and who doesn't understand how great a business it is because they get a royalty on every transaction, or 50-60% of every transaction on credit card. So it's a great business, but for temporary reason, the market gave us the opportunity of buying it at a very attractive level. So perhaps our little advantage to finding a great company, very well known, is that we have a longer term horizon than most people. We don't care that the next quarter or the next year is going to be tough. If we think that the next 5 years will be very promising for the company and earnings will double or something like that, we'll take this opportunity. We'll invest when the short term perspectives are tougher or people are worried about the company. If we think the long term perspectives are sound, and it happens not that often, but it happens quite often.
And what was then in this case the reason that made you comfortable that this was just a temporary issue, that the business would remain intact and would continue despite some focus on the government's part?
Well,
how do you handicap that?
Yeah, well, I tried to figure out what would be the effect of a very restricting law, and I thought that perhaps earnings per share would go down 10 to 15% in the worst case in 2012. So probably at the end of 2010 when I did those calculations, and I said, well, I can live with that. I think even if they only earn $5 a share instead of $6, it's going to be okay. So that was my line of thinking. But at the end, earnings didn't go down 10 to 15%, a few percentage points, but not that much. And the stock has done very well so far. I think it's up to 130 now, and it trades now at a more rational valuation of about 20 times, which for such a great company I think is very reasonable. But it's not as undervalued as it was 2 years ago.
Do you still own it, and when would you then sell it, get out of it?
Well, we don't like to sell. We're not big sellers in general. We'll sell we have 4 reasons that we'll sell a stock. The first reason is that we believe the fundamental is not as good as when we purchase it. And that's the life of investment. I mean, things change, and sometimes they don't change for the best. And when you realize that, the best thing is to sell and buy something else. The second reason, which happens sometimes, is that we don't agree with a management decision. Usually it's a big acquisition. Not all the time, but most of the times we sold a stock for that reason is because they made a big acquisition that we thought was made at a very high price, or we thought that was not very central to their business. I mean, Peter Lynch has this word, diversification. We've seen that so many times. So when one of our company does that, then we don't agree with the management assessment of the acquisition, we won't fight with them. We'll just sell our investment. The third reason, which has been a while since it happened, it's when we think the stock is overvalued. I mean, if Visa would go through 30 or 35 times, at one point you have to say that it's too high. So we do sell when we think that the stock is overvalued. Usually, when I think that the price is at a level that I won't be able to earn 10% a year in the next 5 years, usually we'll sell. And the fourth reason, which probably is the most common, is when we just find something else that we like better. So we'll sell A to buy B, not because A has some kind of big problem, it's just that we like B a little better, or a lot better, depending.
Now, what about it's a book called The Halo Effect, and I don't know if you've read it, about essentially the danger of becoming too fond of a company and thinking that there's a halo around them and they cannot do anything wrong, um, versus perhaps thinking that the market systematically underappreciates truly great businesses, and in a way, even if the multiple is 20, 25, or 30 times, it's the market always underappreciates still how great the business is. What about that dilemma? Where do you, I guess, find the kind of middle ground and ensure that you don't succumb to this?
Well, I think the biggest thing you can have is memory. I mean, we've looked probably thousands of companies over the years. I've been doing this for 20 years, so, and I look at companies every day, and I've seen so many companies that had this halo of being outstanding businesses, that they don't exist anymore. So they weren't that indestructible. So that's the nature of capitalism. It's hard for a company to stay great many, many years. So we've seen it, so we don't want that to prevent us of buying great businesses, but we always keep that in mind. I mean, the cemetery is full of, great businesses or companies that used to be great. And the second part of, we've seen so many great companies that traded at very high P's, that stayed at high P's for many, many years. But, at some point they stopped growing at very high ratios and the P went down, and it's not a very pleasant experience to have a stock that goes from 30 times earnings to 15 times earnings. So we've seen that, and so that's why we try not to overpay, even if we believe that a company is outstanding. And I would say in general, over the years, the P ratio of our companies is similar to the S&P 500. So, except probably in 98, 99 when the S&P was, in the high 20s, I don't think our portfolio was that high. But usually our P ratio is, between 12 to 18 times earnings, depending on. So, usually we try to be very prudent on the price we pay. But at the same time, we've made the mistake so often of not buying a stock because the P looked a little high. So you have to find a little compromise and say, well, it's a great business, but we'll pay a little higher P than we'd like to. And one example of that is lately we bought LKQ, which is an auto part company, and they sell refurbished engines and refurbished parts for auto repairs, and we paid about 18 times earnings, which is it's a little high if you consider that the P of the market is 13 times, so it's a little higher than we usually do. But we thought that the company has very good prospects. I think can continue to grow 15 to 20% a year for the next 5 years. So we thought, well, we'd like the stock to be 20% lower and pay 15 times instead of 18 times, but I think it's okay. And what we usually do, we take a smaller position in the portfolio, so perhaps 2%. And if the stock goes down, or if the stock does nothing for a few years and the P goes down, we'll increase it to 4 or 5% at one point. So we try to find an equilibrium that is very realistic and rational. But you're right, that's not easy. I mean, if it was easy, everybody will be able to do it. And if it was just about finding low P stocks, I mean, everybody will be able to do it. And if it was only buying great companies, I mean, like you said, most people would be able to do it. So you have to find the right balance.
Going back to your description of great businesses and great managers, what came to my mind was also Amazon, and I was curious what's your view on that? On Jeff Bezos and that business?
Well, I have lots of admiration for him, and I've been probably one of the first client of Amazon.com many years ago. Same thing with eBay. I mean, I was at the forefront of these businesses. I saw them, I noticed them at their beginning, and since then I always thought that they were great businesses. I mean, we talked about creativity and artists. I mean, those people that created eBay and Amazon, I think they were great visionaries. And Amazon, I was a little skeptic at first. I remember many years they were losing money, and I said, well, let's hope they make some profit at some point. But now they're making good profits. They're still investing a lot in their future, which probably depresses their profits. But it's very hard for me to evaluate that. I mean, if you look at the P, it's something, I don't know, 60 or 70 times earning. I mean, there's no margin of safety to me, these prices. Probably it's because I don't really get their earning potential in the next 5 years. And so far I've been wrong. I mean, it's been a very good stock. But to me, it's hard to value.
Do you think it perhaps goes into that bucket of a bit too complicated, given what they're doing on the investment side?
Well, the business itself is not that complicated. It's complicated to assess the earning potential. And it could be $10 a share, it could be $5 a share, it could be $15 a share in 5 years. It's very hard to say. So if it's hard to say, I'll pass.
What do you think are the key challenges of your type of investing into great businesses?
Well, I think the key challenge, and we've done that mistake before, is to focus too much on the past. We like to find great businesses and which have a great past, which we admire, and the key thing to make money is that you're not buying the past, you're buying the future. So it's to able to assess the future, and it's so hard. And we've seen so many companies do well for many years, and after that, totally losing their touch. So I think we have to be very disciplined to stay within our circle of competence, companies that we can value easily. We have to focus on people that we truly think are great managers, and probably one of the criteria that people overlook is to accept failures, to accept that probably one stock out of 3 that we'll purchase won't go as planned, and not to be afraid of that, not to be afraid to making a mistake, not to be afraid that some companies that we'll buy won't do as then just accept that 2 out of 3 is okay. That's enough ratio to probably make 12 or 15% a year, which is our objective. Our objective is to add 5% to the market, but if the market does 7 to 10% in the future, we'd like to do 12 to 15. But it's not a linear thing. It's not every year, and it's not in every company we'll purchase. So we just have to accept that some period's going to be tougher, and some stocks that we purchase won't do very well. And I think you have to be confident that you'll do okay, but accept at the same time that some won't do well.
Classic value investors in the tradition of Ben Graham always a bit skeptical of investors, fellow value investors who get excited about great businesses and identifying them, paying up multiples 12 to 18 times that you talked about. What do you think are those people missing?
I'm a big fan of Ben Graham, so I love this book. And I bought some stocks at 7 or 8 times earning and did very well. And I don't think they're missing on anything. I just think that you have to have a investment philosophy that is in tune with your own personality. And my personality, when I get interested in art, is to find the best of the best. I'm like Oscar Wilde that says, I have the simplest of tastes, I only like the best. That's me, that's how I am. I like to buy great assets, I like to buy great works of art, and I know that you have to pay a little bit for quality. Sometimes you get good quality at a very good price, but sometimes you get great quality at a reasonable price, which is okay also. And I don't like the idea of owning a company and hoping for the PE to go up. The company is not doing well, it's not growing, it's not creating, shareholder wealth, but it's so cheap. I hope that at some point it's going to be bought out, or the management will do something to increase shareholder. I'm a patient man, but I don't like this attitude. I like the attitude of being partner with someone that's really building a company, that over 10 years earnings will increase by 500%. I like that. It's not that I consider myself as a growth investor. I like to find companies that create wealth. You mean you've done a good investment because the company has done very well. I like that. And I like to find them not too early, but early. And I always say that we're not venture capitalists, so we won't invest in a company that is not profitable, that has not shown to us that it has built a dominant business model. But we like to buy them when they have proven that it's a profitable business and they have good potential of growing their business, and the CEO is still young and could be in place for the next 10 years. And when it's not very well known, you can buy at a reasonable valuation, even if the prospects are very good. So I have just a different personality than many value managers, and I read the letters of those great value managers that you probably read too, and I admire them. And just that my personality is a little different, and I've tried it. I've tried to in the first few years, and I've done okay also. But I've discovered that I like it better when I find a company I can own 10 years, and I do well not because the market has some kind of reprisal of the business, but because the business has created wealth. But that's me. And I know the danger of paying too much for a great business, so I try to be prudent on that also.
Now, Warren Buffett is the best example of a successful investor in great businesses. What are perhaps some of the lesser well-known fund managers who have the same philosophy and approach that you do, who you admire?
Well, I admire the people and the Sequoia Fund a lot. I go every year to the annual meeting, and I think it's a great team. And they have many people now, and I think David Poppy and Bob Goldfarb are great managers. One probably is less known is Eric Andy. He manages Source Capital at APA Funds in California, and I really like his style. I mean, I read religiously his quarterly letters, and he's a very patient man. I mean, he owns the stock many years. I think his turnover must be less than 10% a year. So, and I think he invests in great businesses too, and I think the name is very accurate because Source Capital is a big source of ideas for me.
What about the dislocations in Europe, and have you looked at that as a potential source of finding great businesses that perhaps are available at a good price?
Yes, we looked at the ones that are really in in my circle of understanding that I really admire are not that cheap. They're trading at close to 20 times earnings, so 18 or 19 or 20 or in the area. So they're not that cheap. Stocks that look very undervalued are probably banks, but how the hell would I be able to value a bank in Italy or Spain? And probably a company like Pirelli in Italy, I've looked at it and the valuation is very low, 7 or 8 times earnings based on 2013. So there's some opportunities there, but I'm not as familiar with the culture there that I am in North America. I mean, in North America, you can find great companies that when their stock is cheap, they're buying back their stock at a very attractive level and creating wealth that way, like TGX or IBM. But in Europe, I think it's not that common. It's pretty rare. So you have this cultural differences. So when I have one of my companies that its stock goes down a lot, and I know they'll be buying back shares at good level, well, I mean, I won't say it's a good thing, but it's you can live with the stock being down, knowing that your company will be able to purchase it at a better level. So there's little cultural differences between Europe and North America, but so far the companies that I found that I liked a lot were in UK. So.
What are perhaps some of the names that you have on your list that are, if the price was right, you'd like to buy?
Well, one stock that went down a few weeks ago and I didn't purchase, and I've been biting my nails about it for the last few days. It's Rochon, which is a company that does valves and actuators. I don't know if I pronounce it right, but Rochon is in UK and they have an extraordinary performance in the past. If you read the annual reports, it's very clear what they do. It's very clear what's their competitive advantage, what the culture is. I think it's an outstanding company, but the P is a little high also. It's close to 20 times. So, but it went down to 17, 18 times a few weeks ago. So almost. But my thing is, I have to sell something else if I want to buy a Rotork. So I have to sell something that I think is less good than Rotork. So,
do you own any names in Europe?
Well, I had a very, very small weight in H&M. It's a very small weight, so just to follow the company, but I think it's one of the best retailers in the world. So it's Swedish based, but I think it's a great, great company.
Now, what about Japan? You mentioned it before, and I'm curious, most value investors dismiss Japan. There are some great businesses there, some global leaders. Do you find any value there?
Well, about 5 years ago, we purchased Nitori, which is a retail stores of. It's like it's similar to Bed Bath and Beyond and IKEA. It's a little mix of those two. So, but they were growing pretty fast, and we thought that it was very well managed, and we did very well with that. So, but so far it's been the only stock that we had bought in Japan.
What about the environment? The low, record low level of interest rates. The stock market, in a way, is a discounter of future earnings. That's its main function, and when that variable gets so screwed up, how do you deal with that in your thinking? Because most of your companies are, in a way, when you buy them, you're discounting for a very long period of time. So having the treasury rate at 1 or 2% versus 5 makes a big difference. Have you adjusted anything in your thinking or in your models to account for that?
Not really, because I don't want to discount things at 2 or 3%. I mean, like I told you, I want to have 12 to 15% annual returns on my investments. So if I lower my discount rate, I won't be able to obtain those results. I don't think the low interest rates are sustainable for many years, but what do I know about interest rates? I just, follow them and encapsulate in my valuation. I'll tell you, I try to use 6%. So if I think I can discount things at 6% and buy them at half their value, probably I'll do well. And at some point I think interest rates will go up. Well, I think the stock market is so low that even if it would go up to 6%, I don't think that valuation would be much different. In fact, I think the S&P is trading at 13 times earnings, which by any way of looking at it, I think is undervalued.
Are you concerned about the debasement of currencies and potentially how it could lead to hyperinflation and in terms of portfolio management or risk management, is there anything you do in particular, or are you just happy to hold great businesses in the vein of Warren Buffett, who said they're the, I guess, best among all the bad alternatives in times of inflation?
Well, I agree with that. I mean, I always agree with Warren Buffett. So, I mean, that's not a big thing to agree with the greatest manager of all time. But we try to find companies that we believe will do well in inflationary periods, because we know there'll be some. And I remember when I started to invest 20 years ago, I wanted to invest for the next 60 years. That's what I was 70 years old. So I said, well, in the next 60 years, there'll probably be at least 6 or 7 recessions. And there's got to be some periods of high inflation and some periods of low inflation. I'll just accept that from the start. Not try to time my investment based on I fear recessions and inflation. I'll say, I'll accept it. I'll adjust my investment philosophy for a world that, will have ups and downs in the economy and ups and downs in inflation. I mean, inflation is a byproduct of our capitalist system. And in some countries it's a little higher than in the others, but I think it's very rational to think that going forward inflation will be probably 3% a year. Some years it's going to be 6% and some years it's going to be 0, but I don't think it's very wise to think that inflation will stay low for many years, considering all the debts of the governments, and probably one way they'll manage to go through all those debts in the future is probably depreciate the currency through inflation. Probably it's not going to be a planned thing, but it's going to be probably a consequence. And I accept that. I accept that probably at some point interest rates will go up and inflation will go up, and we try to find investment that in any environment the company will do well. We don't want a company that will go under if there's a big recession. I mean, if you look at Bank of the Ozarks and Wells Fargo, they were able to benefit from the recession. They make good acquisition at a very good price, and in the next 5 years they will earn more than they would have if we didn't have the 2008, 2009 big recession.
What are some of the books or resources that you like to read to improve you mentioned the word judgment many times, to improve your investment judgment?
Well, I try to read a lot of things, mostly what I'm interested in. And some period of my life I read all the books I could find on investing and value investing. I read almost every book that were written on Warren Buffett. Read all Philip Fisher's book and Ben Graham, and I really like the books of John Train, the Money Masters, that were written in the 80s. And I read books on psychology or history or great businessmen. I like to read biography of great businessmen. I mean, that's very inspiring, I think. And the one I'm reading right now is the biography of the founder of Four Seasons Hotels, And I read lots of things on many subjects, and I try to have a very broad visions of our civilization. I think it helps to really have a very open mind when we come to investment. But as for the regular things, well, I love to read all those interviews with great money managers like the one you write, and I like to read Value Line on a weekly basis. I think Value Line is very well done, and I like the way they present things in the very old-fashioned way of little newspaper, paper, very thin with lots of little numbers. So I think it's kind of very basic, but it works very well.
Great. François, thank you so much for your time.